It wasn't too long ago that the market was calling the Fed's bluff and winning out as far as forward guidance was concerned, but into 2017 we saw a shift on that front, with Fed guidance finally delivering as promised by way of 3 rate hikes. And in 2018, the market is taking the Fed outlook more seriously, already on board with calls for another 3 rate hikes this year, one expected this month. The question many are asking right now is if we'll get 4 rate hikes instead of 3. So what's changed? The big change has come from the inflation front. Whereas back in 2017, there were no signs of inflation and we were still in that prolonged period of subdued inflation, into 2018, we are starting to see a pickup on the inflation front, something that will force the Fed to consider a more accelerated normalization process. Janet Yellen had warned of the risk of inflation shooting up out of nowhere and expressed the importance of making sure the Fed would not fall behind the curve. And so into 2018, those signs are coming via a number of indicators, one of them being the average hourly earnings component in the U.S. employment report. We've said for many months now that the headline reading in the jobs report is less relevant, with NFPs and the unemployment rate running at levels already justifying a move to higher rates. Right now, it continues to be about the average hourly earnings print. If this component exceeds expectation, look out for a fresh batch of US dollar demand and sell-off in stocks. If, on the other hand, the data comes in soft, the dollar will likely come under renewed downside pressure and stocks could rally. As far as the breakdown of the data goes, average hourly earnings on a year-over-year basis are expected to tick down to 2.8% from 2.9% previous, and on the month-on-month, they're expected to tick down to 0.2% from 0.3% previous. As far as the NFP print goes, it's expected to hold steady at 200K. The unemployment rate is expected to drop down to 4% from 4.1% previous. And we have that participation rate, which is expected to tick down to 62.5% from 62.7% previous. That's all for now.